Most of the time, as I've explained earlier in this course, we treat the market price of stock as being fair. It's not the right price, but it's the fair price. It's as likely to be too high as it is to be too low. With an initial public offering, or IPO, though, all bets are off. When 3Com's Palm division had its IPO on March 2nd, 2000, it went from its offering price of $38 to over $95 on the first day. If you're scoring at home, that's a 250% return in one day. By comparison, the S&P 500 barely budged, inching up less than 0.2%. Palm outperformed the S&P 500 by not quite 1,400 times that day. What in the world is going on? How do IPOs work anyway? Is that price behavior typical for IPOs? That's a fabulous one-day return, but what's the long-run performance like? It turns out that the pricing of IPOs and their expected returns and risks are nothing like those of securities that are already trading. If you understand how and why companies go public, then you can better assess the benefits of investing in IPOs and those risks. Let's start by decoding what the name initial public offering means. What is an IPO anyway? Like so much of financial terminology, we benefit because the language evolved from what people use on Wall Street and financial markets. We can figure this out without turning to the internet. Initial means first. Public means that whatever is going on isn't restricted to some select group of people. Offering sounds as if the company is selling something. A good guess of what an initial public offering is would be the first time that a company sells something to the masses. If we deduce that, then the only thing we'd be missing is what the company is selling. It might be a new product, but in a course titled How the Stock Market Works, they're probably selling shares in the company's stock to the general public for the first time. And it's so often the case with finance, a little common sense gets us the right answer. An IPO is the first sale of stock by a privately held company to the public. Usually the company will be a smaller firm, often relatively new, and looking to grow more rapidly than it could without tapping a new source of funds. Why do companies go public? Let's see if we can come up with some reasonable guesses. First, who's selling the shares? The simple answer is the company, but if we remember that a corporation is just a legal shell that we wrap around a bag of goodies, then we realize that what we really mean is that the current owners are selling the shares. Put yourself in the place of a guy who started a company and built it over time. You may have sold a part of it to a partner, but you still own a big chunk of it. You might be worth $100 million, but $90 million is tied up in the company. That's not the recipe for a good night's sleep. You're not diversified, and a corporate disaster can wreck all of your hard work and financial success. Not all companies that have IPOs are still controlled by the founder, of course, but it's almost always the case that whoever does own the company at the time has a huge stake that didn't used to be so huge. That's one reason companies go public. The owner wants to cash out, either to diversify his holdings or perhaps to raise some cash to change his lifestyle. We said owner, but the odds are that there are several owners. When you brought your brother Tony on board as a partner, he bought 10% of the company. Now, he wants to cash out and take early retirement, but he just can't do that because he can't find a buyer for his 10% stake. Your money's all tied up in the firm too, so you can't buy him out. He's not happy about that, and that means you have an unhappy employee and an unhappy business partner. That's bad. You wouldn't have this problem if the firm were publicly traded. Shareholders gain liquidity by going public. Another reason firms go public is to